Today's topic, 10 commonly missed tax deductions. For all of my physicians, my dentists, my vets, all the other high income professionals, I am going to break this down into two sections. First section will be for all of you that have W-2 income. These 5 will pertain specifically to you. Now, technically, all 10 will pertain to anyone with self-employment income or 1099 income. First 5, even though I label them as W-2, remember, they also apply to you. But then the last 5 only apply to you. So stay tuned for all of those. We'll cover those. Some of these will be very common, ones that you knew were out there, but maybe you just learn a little bit something about them. And then others may be more unique where you have not heard of them. And the only way you're going to find out, well, is if you stay tuned, because that's all coming up next. First one, W-2 group. So remember, the first 5 are all for W-2. Charity. Charitable giving. I've covered this in a few other videos. We have videos where we really walk through the Schedule A and what goes into charitable giving. And as I always say, I know you don't give the charity for the tax benefits, but it's one of the side benefits. But one of the most commonly missed tax deductions we see from our physicians, from our clients, is not properly tracking their charitable contributions. And on top of that, probably not understanding their Schedule A. There is a big difference between the standard deduction and itemized deductions. And remember, you only get charitable contributions once you are itemizing your deductions. Some ways to make itemizing a little bit easier with charitable giving, you have something called a donor advised fund, or what we call a DAF. We have a few different videos on the DAF, but with a DAF, you can maybe transition appreciated stock into that. You can do something that we love called bunching contributions. So if you historically have given $5,000 every single year to the Red Cross, but you're still not getting above that standard deduction, well, maybe you do $10,000 in 1 year to the donor advised fund. So you're bunching those contributions. Or maybe you do $15,000 in 1 year to the donor advised fund. And then that'll give you a $15,000 tax deduction, an itemized tax deduction, assuming that gets you above the standard deduction limit, which is a whole nother story. That would give you that benefit there. And then the cool part would be you can still give out $5,000 per year then from the donor advised fund. Now, you don't get tax benefits for that, right? You got everything in that first year for that $15,000. But the first common tax mistake we see specifically on the W-2 side, but really this one applies to everyone, believe me, is that charitable giving. Next up, the mortgage interest expense. So what this deduction is the actual amount of interest you've paid on your mortgage. So if you're a renter, this one does not pertain to you. But this is another one that is really important to your Schedule A, because if the standard deduction is higher than your itemized deductions, it's a moot point. But the nice thing about this one is it's happening regardless, right? You have your home, you're paying interest on it, or maybe you are also been paid off your mortgage already, but most of us will have that interest expense on there. So just keep an eye out for the form called a 1098. So 1098, that's the form that will report all of this. It'll also show your property taxes on it, and it all goes into your itemized deductions, assuming that they're going to be higher than your standard deduction. Few unique things here. Remember, they changed the limits now. Interest is deductible under $750,000 mortgage. This is another important one because married filing separately extremely common for physicians and student loans. Remember, that drops the whole way down to $375,000 when you are utilizing married filing separately. Now, ideally, married filing separately is not a forever, right? Hopefully it's just a few years. We get PSLF and then we move on, but just keep that in mind. But another common missed tax deduction is that 1098, which is your mortgage interest expense. And still, even with that, if you're below the standard deduction, you're not actually getting that deduction. This is why the Schedule A is so important in understanding the moving parts that come into standard versus itemized. Number 3, your retirement accounts. The low-hanging fruit, as I always call it. These are the easy ones. If you are not maximizing your retirement accounts, you're missing out on an easy tax deduction. And I also throw in your HSA here, your health savings account. If you are in an HSA eligible health plan, that is another easy one to take advantage of. A few bonus tidbits in here. If you have 1099 income, use the sole OK, not the SEP IRA. We don't like the SEP IRA because it blocks your backdoor Roth IRA. So utilize the sole OK. And remember, the $23,000 is the easy part. You likely will also be able to do some form of a profit share on there, and you might be able to get all the way up to $69,000. Now, these are your 2024 limits that I'm using there, the 23,000 and then the 69,000. Those numbers will change. Simple Google search, check what the IRS limits are for the year that you're watching this, but you can also get more money into there. Now, if you're watching this as an academic physician and you have access to a 457B, just make sure you understand the difference between a government and a non-government 457B plan. The non-government 457B plan gives you 2 risks. First risk is they go out of business. If they go out of business, you are likely never going to see that money. It was never yours. That's one of the unique things of that 457B plan. The other thing is understand the withdrawal. So when you separate from service, what are the rules? Do they force you to take it all out next year? Do they force you to take it out over the next 5 years? Can you defer it till retirement age and then spread out over 10 years? Ideally, we're looking for that. You want to be able to defer it till later and then spread it out over a few years. But number 3, commonly missed tax deduction is just not taking full advantage of the retirement plans, and then also bonus points there for the HSA. Number 4, healthcare expenses. Hopefully you don't have to worry about this one, because if you're worried about this one, you probably had a pretty bad health year, and I don't want that for anybody. But the key here is it has to be above 7.5% of your adjusted gross income. So it becomes a pretty large number. So if you're not above 7.5% of your AGI, you don't get that deduction. But if you did have a year where medical costs were higher than what you would have ever wanted, just make sure you're tracking those expenses. Make sure you're talking with your accountant about that. That is one where ideally we don't see it a lot, but when it does pop up, it can be a nice benefit in terms of taxes because this will add to your itemized deductions, but it has to go above 7.5% of your AGI. The other thing to keep in mind there, if you are self-employed, don't forget all your health insurance premiums. I know that they are likely painful to pay, but that is a tax deduction. So that is one side benefit in there. So make sure you track those, make sure you're giving those to your accountant, but those are actually 100% deductible as a self-employed individual. If you're W-2, those premiums are already being calculated through your W-2. So you're more or less just worried about tracking the actual expenses. But number 4, on the W-2 side, but also on the business owner side here, is make sure you're tracking those healthcare expenses and don't miss out on any of those deductions if they pertain to you in that year. Last but not least, for the W-2 group, and again, 1099 group, because all 10 apply to you, but tax loss harvesting. And this is one where we say we don't want to get too carried away with this. Hopefully you're not harvesting losses too many years in a row, but there's going to be certain years where maybe certain asset classes are down and you can take advantage of this tax loss harvesting. And if you're not familiar with this term, what it says is you're going to go in and sell some of your losses. So you have a stock or an index fund that has a loss, you're going to realize that loss. And you're likely doing it to either bank them for future gains, or you get a little bit of tax arbitrage in there. You can actually offset up to $3,000 of losses against your ordinary income in a given year. So keep an eye out for tax loss harvesting. This only pertains to your non-qualified accounts. So think of this as your individual brokerage account or your joint investment account. It doesn't pertain to a Roth IRA or your 401k or 403b. These are qualified accounts. So tax loss harvesting, non-qualified accounts, see if there's any areas that you can take advantage of those. Usually this is something you're looking at towards later in the year as you get your portfolio cleaned up and see if there's any tax loss harvesting or even something called tax gain harvesting, depending on what we think capital gains rates might be at in the future. But tax loss harvesting, good strategy in there. Try not to miss that one. All right. If you're still with me, we are now transitioning to our 1099 group. So for all of my W-2 employees, you can now exit or stay around, learn something new about taxes. But these rules are only going to pertain to self-employed individuals. But remember, if you are a W-2 physician and you have some side income, some 1099 income, you're back in play. First one I wrote down, this one's a unique one. I'm going to venture out to say you may not have heard of this one. It's called the Augusta Rule. And the Augusta Rule says that you can actually rent out your house for up to 14 days as a business expense, and you don't have to pay taxes on that. Now, there are a lot of moving parts, and there are too many moving parts for a non-CPA to explain to you in a 15-minute YouTube video. So I would suggest you take this idea, and if this is something where you utilize your house for maybe a team retreat or maybe for board meetings or something of that nature, this could be a really nice tax deduction for you where essentially the business is paying you to use the property, but it's not taxable to you. So neat little idea there, but check with your accountant, work with your tax team to see if this one really can fit in with your plan in particular. But the first one for the 1099 group, the Augusta Rule. Next up, we call it the Section 179. And what this means is for certain expenses like technology, equipment, or maybe a business vehicle, instead of depreciating the asset over its set schedule, you can take the full depreciation in a given year. So let's just say you need to go buy new equipment for the medical office or for the dental office, and it costs $20,000. Instead of spreading that out over a certain amount of years, you can take that entire deduction in that first year. Current limit, I think, is around $1.2 million where you can take it in one given year. Again, with any of these, the business side is more complicated, right? You got a lot more moving parts. You want to work with your accountant, but very common tax tool that you can utilize, especially as a business owner, especially again, if you have equipment or if you're buying new technology or if you're getting a business vehicle, check out section 179. Ask your accountant about the business tax deductions centered around section 179. But that's a good one. Instead of spreading out, you can take it all in a given year. Maybe you had a higher income year and you're trying to get better deduction in a given year. That one can be a slam dunk instead of depreciating it over a few years instead. Next up, one of my favorites, because I am coming to you live from my home office, one of my favorite tax deductions, the home office deduction. And there's two ways you can go after this one. I always say the regular, which is your percentage. I want to make sure they actually call it the regular because I always call it the percentage rule, versus the simple rule. Simple rule, you're likely not going to get nearly as much bang for your buck. Simple rule is this: $5 per square foot. Here's the bummer: capped out at 300 square feet. You can't go more than 1,500 buckaroos there. So not a huge deduction. And I can tell you, I have used the home office deduction pretty much since WealthKeel was in existence. Even though we do have an office where we'll meet with clients, I do a lot of my work from home with our clients being across the US. So I use a home office for the bulk of my day-to-day activity. And I can tell you, we are well above $1,500 every single year when we do our home tax deduction. I have a nice little spreadsheet where we track mortgage interest, utilities, insurance, anything bill-wise. And then what you do is you take the square footage of your office. So let's just say my office is 10% of the square footage of our entire home. We get 10% deduction then on those other expenses. So a really neat one there. Again, any 1099 income and you use a home office, and it has to be a real office. That's the one where sometimes people bend this rule a little bit too much. They're like, well, I worked out of my kitchen and the kitchen was 300 square feet. That's not an office, right? It needs to be an actual office to get this deduction. But home office deduction, low hanging fruit for any 1099 income, one of the better deductions out there. Like I said, lean towards the percentage one. Takes a little bit more work to track everything. You're just not going to get a lot of bang for your buck on the simple $5 per square foot rule. Next up, professional development. This one used to actually be for both groups, but unfortunately we lost this one for W-2. But professional development, so anything that you're doing to continue to learn, you can take a deduction on that on the business owner side, on the 1099 side. If I'm going to go try to get, I already have my CFP. Let's say when I was going to get my CFP, right, I was developing my professional side. I was adding that. Eventually I want to go get my EA, my enrolled agent, right? Those are all deductible business expenses. You as the physician, if you're doing any extra work to improve your skill set, maybe you're going out to a conference that's going to have some benefits to it in terms of your professional development, all deductible expenses. Make sure you're tracking that, make sure you're giving it to your accountant, and you should be in a really good spot there. But number 4 on the 1099 side, professional development, that is a winner. Fortunately, we lost that one on the W-2 side, but still for 1099 income, that is a great deduction to take advantage of. Last but not least, we end with really one of the largest tax deductions we've ever really seen out there, and that is what we call the QBI, or the 199A. For QBI, here's the things that we got to keep in mind. A certain income threshold. I'm going to read it to you, and this is your 2023 numbers. Anywhere below 364, I'm only going to do married filing jointly. You can Google search all these things, but married filing jointly, if you're under $364,200 to be precise, this is one of your best deductions. Why? It is literally 20% of the income. It's one of the biggest and easiest tax deductions out there right now. This one, I believe, is set to sunset in 2026, if I'm not mistaken. If you go above $464 and $200 to be precise, you were completely phased out. So between 364 and 464, there's a phase out range. And then once you're above that, it's completely gone. But if you have some 1099 income, or you have a lot of 1099 income, but you're still under 364, or you have a full W-2 roll, but you have some 1099 income of, call it 100, 200K, this is a fantastic, if not the best and easiest tax deduction out there. Don't miss out on QBI if you're working with an accountant with a CPA, even heck, the tax planning software. As soon as you plug in that self-employment income, they're likely looking for this one. But if not, make sure you bring it to their attention. That is one of the best and easiest ones out there on the tax deduction side for our 1099 physicians, our 1099 individuals. And there you have it. 10 commonly missed tax deductions, 10 in particular for our 1099 business owners, and then 5 specifically for our W-2 employees. But 10 great tax ideas to keep in mind, whether they apply to you or maybe someone you know or a loved one. Really great things to keep in mind. A lot of those are going to be year end. So if you're watching this and we're already into 2024 or a future year at that point, think about your tax planning throughout the year. A lot of tax planning will have a hard cutoff on 12/31. Some will let you do into the earlier year, but 10 great tax deductions to keep an eye on. If you have not subscribed, now's a great time to subscribe to the channel. If you click on this little bell icon, you'll get a notification every time we release a new video. We are now releasing content on a weekly basis. Thanks to your views, your comments, your love. We're here. Every single week, we're releasing a new video. Thank you for hanging out with me for the last 15 minutes or so. And as always, I will catch you on the next video.